Hello, everybody. My name is Ellman, the blue collar investor, welcoming you to this BCI podcast number 64. This one is titled Creating Dividend-like Income for Non-Dividend Stocks. We're going to be using a real-life example with Paycom Software, Inc., which trades on the New York Stock Exchange under the ticker symbol PAYC. Over the years, so many of the members of the blue-collar investor community have told me that they only want to focus on dividend stocks. The reason is that they feel they're getting additional income using dividend stocks. The problem with that is there are so many great performing companies that do not issue dividends. They use their extra cash for research and development rather than giving that cash back to shareholders. And these are companies, many of them, that are elite performers from every perspective. So why miss out on those particular stocks when we can use covered call writing to create a dividend-like income for them? Now, over the years, I've written how covered call writing can be crafted to achieve so many different goals. Let me give you a few examples. We could use it to generate weekly and monthly income, traditional covered call writing. That's how I use it. Now, some people use it for portfolio overriding, where they do not use stock selection in the process. They just simply use stocks they already own in their portfolio and leverage those stocks to generate additional income by writing covered calls. Another way to use it is to diversify with exchange-traded funds. That's a strategy I use in my mother's portfolio. I've written about how to use covered call writing to create a portfolio of large cap tech companies without taking any money out of our savings account. Another strategy that I've alluded to in my work is to create a covered call writing portfolio, which does include stocks that generate dividends, thereby having a strategy with the potential for 3 income streams per trade. 1, from share appreciation, because we only use out of the money strikes if that's the strategy we're using. 2, from option premium, and 3, from dividend income. Today, in this podcast, we're going to focus in another way of using covered call writing, and that is to convert non-dividend stocks like Paycom into dividend-like stocks. Now, back on August 30th, 2019, if we took a look at the IBD Smart Select ranking, which includes fundamental and technical rankings, not only for the stock, but also for the industry that the stock is located in, you'll see that Paycom was ranked number 1 in its industry. So it was an outstanding performer at that point in time. If we took a look at the checklist, which includes 6 rankings, which are once again fundamental and technical for both the stock and its industry, all green, which means all elite performers, the highest ranking in all 6 of those categories. Now, if we actually charted Paycom on August 30th, 2019, we would see that the moving averages were bullish, ascending. The 20-day exponential moving average was higher than the longer-term 100-day exponential moving average. If we took a look at the confirming momentum indicators, the MACD histogram was also bullish, as was the stochastic oscillator. And these parameters were confirmed by average to above average volume. So a beautiful technical chart, in addition to the fundamental elite rankings that we alluded to in the last slide. Okay, so here we have a stock that's a great performer fundamentally and technically, but it issues no dividend. Should we just ignore this stock, or should we use covered call writing to create a dividend-like income? If we did so, in this hypothetical, we're going to assume a 4% goal in terms of the dividend. Well, 4% of Paycom, which was trading at the time at $254.10, would represent an annualized return of $10.16 per share. In other words, it would be the same as getting a 4% annualized dividend. Now, if we were to break that up into quarters, because dividends do come out quarterly, then that 1016 would now become $2.54 per share. So all we have to do is make 4 trades per year. Not every month, not every week, but 4 times a year. And we do this and we look to generate option premium of 254. Now, we would only select out of the money strikes because we want to allow our appreciating stock to continue to appreciate. And we would also write these calls on months that do not have earnings reports coming out, because that would create, it would cap the upside of a favorable report and not do too much for us on the downside. So we avoid the quarterly months when the earnings reports are coming out. So in other words, we would have then choices of 8 different months to write these 4 trades. Now, another advantage of this over dividend stocks is that we don't have any issues with ex-dividend dates, because those of you familiar with covered call writing know that the most common reason for early exercise is an ex-dividend date. And since stocks like Paycom do not generate dividends, there's no ex date to be concerned about. So that's another advantage of using this strategy over stocks that have conventional dividends. So now on August 30th, 2019, we're going to check out the option chain for out of the money strikes that will generate approximately $2.54 a share. Now, this would represent a 3-week return at the time that I'm checking the option chain. And it showed that the $270 strike out of the money, remember Paycom is trading at $254.10, generated a premium, a bid price of $2.70. So slightly more than our 254 goal. So all is good. And then that would create a dividend-like income of more than 4% annualized. Let's summarize. Dividend-like income for Paycom can be created with only 4 trades per year. The way to do it is to use only out-of-the-money strikes that will allow the stock to continue to appreciate in value, and look to achieve about $2.54 per quarter. We write calls on months when there is no earnings report. No problem, because that'll give us 8 other months to write our calls. Now, if we use this strategy, then high quality non-dividend stocks no longer have to be ruled out when dividend income is a priority, because we're going to use covered call writing to create that dividend-like cash flow. Before I close, I want to, as I always do on these podcasts, remind everybody, please take advantage of all the free resources on the Blue Collar Investor website, www.thebluecollarinvestor.com. It's there for you. It's free. We have calculators. We have files. We have articles, Beginner's Corner tutorials. So look for the free resources link. Look for the Beginner's Corner link on our web pages, and take advantage of all these free resources that we have available to you, the BCI community. To take these strategies up to a master's level, have a look in our store where we have books in various formats, PDFs. We have soft-covered books, and a few have hardcovers. We also have online DVD streaming programs. We have calculators, spreadsheets, trade planners, online mentoring programs. Everything you could possibly need to master the strategies of covered call writing and selling cash-secured puts. Visit our store, www.thebluecollarinvestor.com/store. Ladies and gentlemen, thank you so much for taking the time to listen to, and in some cases watch, this BCI podcast, number 64, Creating Dividend-Like Income for Non-Dividend Stocks. Hope you enjoyed it, and most importantly, hope it puts some more cash in your pockets. As always, this is Alan Ellman, the Blue Collar Investor. Take care, everybody.